Okay, so Treasury stock. So this is related to this topic of stock buybacks, okay? Where a company is going to go to the market and kind of like retiring a bond early, right? We talked about this in chapter 12, where the company goes to the market, buys their own bonds back, and then they don't have to pay the bonds, right? They kind of retire them early. So this is similarly a transaction, but instead of a liability like a bond, it's buying back their own stock. Okay, so why would a company do this? Um, for one, uh, as we talked about, uh, the more shares you have outstanding, the more slices they get to cut your pie into of profit. So if you take shares off the market, you're going to have this anti-dilutive effect. Okay, so for example, if you had $100 of net income and you had 10 shares, that means that you split this $100 into 10 slices, and each slice is $10 per share. But if you reduce this to 8 shares, what is it now? Is this going to go, is it more or less than 10? It's 10 point something. It's higher, okay? Because you have less slices. You have the same $100 in net income, but you're splitting it over less number of shares. So each share is going to get more portion of that net income. Okay, so this is what we call anti-dilutive. Oftentimes, companies are issuing more shares. It's going to go from 10 to 12 to 15. So you have to share. But you're hoping when you do this, when you increase the share count, this $100 is going to go up to 200 to whatever. You're growing your business, right? When you issue new shares, you're taking in capital, you're building more factories, expanding into new markets. So you're hoping that the dilution by issuing new shares is offset by an increase in net income. Okay, if you're issuing shares and your net income increases, but the proportion, the earnings per share doesn't increase, then you're just running on a treadmill. There's no reason to even grow. Okay, so you're hoping that your investments are going to increase your return as an equity holder. You as a existing shareholder are not really happy um, where your business expands and generates more revenue, or your earnings per share is not expanding. Now, the CEO, again, this is a big principal agent problem. The CEO of a company is happy to do that. Why are they happy to do that? Why would a CEO of a company expand the business even though it wasn't growing earnings per share? Exactly. That's a huge part of it because you're running now instead of a $1 billion company, you're running a $10 billion company, right? So though it's not accretive, as we say, to the shareholder, the CEO is benefiting because they're running a bigger, their little kingdom is bigger. Okay. So this again is a big, this is like mergers and acquisitions. There are so many CEOs that will just look for mergers to buy other companies. And it's not necessarily in the best interest of the shareholder, but the CEO benefits because their kingdom is bigger. It's like a what is it? Imperialism. Okay. These countries will go out and try to conquer territories. They can't exactly hold them and like profit from them, but their territory is expanded. So they have more clout. Okay. So this is the same thing with companies and CEOs. So it's very rare for companies to have very shareholder minded managers. And there's certain companies that have a culture that's built around that. They will not do acquisitions or expand the business unless it's accretive to the shareholders. And you want to find those companies and invest in them because then you're gonna you're not just the play money of the CEO who's trying to expand their empire. They're actually trying to create value for you, and um, that's kind of rare in the corporate world, unfortunately. Okay, so creates short-term demand for the company's stock. So just a company going to the stock market and buying their own shares, it's all supply and demand driven. That's what is in the short term determining the price per share. So it's a support for the shares, okay, to just create demand for it. It also avoids takeovers, okay. So if there is some activist shareholder that's trying to go to the market to buy a stake in your company so that they can put someone on the board and kind of take over the company, by the company buying its own shares back, there's less available for a hostile investor to buy. So some companies will burn money buying their own stock just to prevent, again, this is a CEO trying to protect their job or whatever, right? Because if an activist investor comes in, maybe the CEO is going to get fired. Okay. So some CEOs and managers will sacrifice the shareholder and their capital to just protect their job. Okay. So this is this is another one. Um, it's more tax efficient for shareholders as a means of returning capital. Now, this is not always the case. Sometimes the investors just want cash in their hand, especially if the stock is overpriced. Okay, if the company is giving cash, returning cash by just buying back stock, the existing shareholders would probably rather have the cash in their hands because the company is essentially overpaying for the shares. Okay, so this one is it depends on what's going on. The specifics and the context matter. Okay, so how are the treasury stock transactions accounted for? Well, the company's going to pay cash, right? Because it's like they're going out and purchasing the shares. So you're going to credit cash, and we're going to have this new account called treasury stock. Okay, and this is going to be a contra equity account because it's going to be a debit normal. Okay, we know that our other equity accounts are credit normal, but this treasury stock account is a contra account. It's contra. The value of the stock is recorded at cost. So we're going to see, and there's no reference to par value. So in this contra account, treasury stock, the par value doesn't matter. It's just what we're paying for it. The balance of this is recorded um, underneath retained earnings and is a reduction of equity. Okay, but again, since it's a contra account. If the shares are sold later, because once you buy the shares, you could reissue them. Okay, um, and we'll do some sample transactions to see this. Okay, but the key thing to remember is that this treasury stock account is always going to be accounted for at your cost. Okay, and again, I'll show you that with some examples. Okay, so the retirement of stock is treasury stock, which is canceled and cannot be resold or reissued. Okay, so I think let's look at some transactions, and I think that will hopefully answer some questions that you may have. So save your questions for a little bit. So on March 31st, we purchased 1,000 shares from the market, and we're paying $5 per share. Okay, so we are going to credit cash 5,000. Again, 1,000 shares, we're paying $5 per share, and we're going to debit this treasury stock account, which again is an equity account, but it's a contra account, which is why it's debit normal. So now let's say we resell. So we have 1,000 shares now in our treasury stock account. We're going to resell 200 of those, and we're going to get $6 a share. So did we do good? Exactly. This is buy low, sell high. You bought for $5, you're selling for 6. So you're going to receive cash because you're selling those shares back to the market. This is the key accounting weird thing. Okay. This treasury stock account, you're always gonna use your historical cost of $5. So this 200 shares at $5, you're gonna kind of reduce the balance by those 200 shares at its historical cost. And this gain, you can say, this $200 gain is gonna be in this account, paid in capital from treasury stock transaction. This is like, basically it's like a revenue, okay? This is going to increase the value of our shareholder equity. Because as we said, we bought low and we sold high. So that's kind of like a profit that we just made. So that's going to benefit the shareholders. That extra profit is increasing my shareholder equity. Okay, but we're going to put it in this account called paid in capital from treasury stock transaction. Okay, so the T accounts, again, we started with 1,000 shares. This is $5, $5, right? This 5 times 200 is 1,000. And so now this balance here is 800 shares because we had 1,000, we sold 200, and so we have 800 left. And again, this is always accounted for at the historical cost. And now we have a $200 balance here in this paid in capital from Treasury stock transaction. Okay, so now we resell 250 more shares because remember we had 1,000. We resold 200, so we have 800, and now we're gonna resell 250 more. Okay, so we're gonna get cash again. Again, we're always gonna account for this at historical cost. So $5 a share, 250 shares, and you can see here to make the journal entry balance, we need a debit instead of a credit. And what we're gonna do is this is kind of like a loss, right? We bought for 5, we're selling for a lower price now. So we took a little loss. But we are only going to take it away from this piggy bank that we have already set up here. We had that gain. We're going to now kind of take away from that a little bit. We're going to reduce that from this next loss transaction. And again, this is always, in this one, it's always going to be at $5 per share. Okay. So now we resell another 300. So at this point, again, we have 550. We're selling another 300. We're going to get $1,200 in cash, which is 4 times 300. We're going to account for this, again, always at $5 a share. So this is $5 times 300. Now, this is a little tricky, okay? In this account, we only have a piggy bank of $125. We can only debit this 125 to make it 0. Okay, so once we do that, we still see we have a loss to make this account balance because, again, we bought for 5, we're selling for 4, we took a pretty big loss here. So we're going to reduce this to 0 here. And then the rest of the loss, we're just going to take out directly from retained earnings. So you can see here how this all plays out. So in our treasury stock transaction, this is our original purchase. We had these 3 sales transactions. I think this first one was at $6. This one was for $4.70, and this one was for $4. Okay, we've zeroed this out because even though we had a gain from the $6 one, our subsequent 2 transactions we had losses. This is zeroed out, and then we still even had to dip into retained earnings and reduce this. So far this has kind of been a bonehead kind of plan that we've been doing. We've taken a loss. We've reduced our retained earnings because of this. We don't know how it's going to play out. We still have these 250 shares. Maybe they're going to go back up and we'll make up even for this loss, but who knows? But so far we're kind of losing. And then last transaction, let's say we buy more shares, but now it's at a different cost basis, $3.90. So we have a new entry into treasury stock. We have the cash going out. And now what we have is, it's kind of like inventory. We have 2 layers, right? We had these original all were transacting at $5. We now have this new layer coming in. And so this balance is made up of 750 shares, but at 2 different cost bases. So when we now do subsequent transactions, we'll have to determine from what lot these are coming from. Are we selling these $5 shares? Are we selling these $3.90 shares? And that will determine whether we have a gain or loss, right? Because if we sell it for $4, we would have a gain if we were using these shares. We would have a loss if we were doing these shares. Okay, so we'll have to, kind of like inventory, like we learned in chapter 6, this is like specific identification. You'll have to use that method to kind of account for it going forward.